My name is Roxy Flieger. I am the Business Development and Commercial Loan Officer for the southwest corner of the state. And joining me today is Steve Dushik, our President and CEO. I will handle the bulk of the presentation, and Steve will interject as he has additional comments, as well as cover a couple of pieces. So let's go ahead and get started. There are tons of options in the small business financing toolbox, and today we are specifically going to focus on one SBA program, that being what we know as the heavy hitter, or the SBA 504 program. Generally, this is a well-known program. It's the common reasons for using it are for owner-occupied real estate improvements and equipment. It offers some significant benefits to borrowers, including lower down payments than conventional financing, as well as below market fixed interest rates for 10 or 20-year terms. It works in conjunction with a primary lender, and we can provide loans up to $5 million, which would be the equivalent of a $12 million total project, or $5.5 million for a manufacturing project. And it's for for-profit businesses. So that's kind of a general overview. We're going to dig into the details a bit and talk about how to use the program in a broader scale than maybe you have thought about it today. So the first thing we're going to do is do a quick poll to see how many projects the attendees have been involved with. So on your screen, you'll see a few different options there. If you've never done a 504, if you've done just a couple, if you've done 5 to 10, or if you've done more than 10. So I'll leave that up for just a moment. Looks like we've got close to most of the people voting, with over half of them have never done a 504, and just a little under half have done 1 to 5. So a fairly new crowd to the 504 program, or maybe somebody that just wants more information about it. So I'm going to close that poll, and you can see the results. So 56% of the people on the call have never done a 504, and 44% have done 1 to 5. So let's start with the purpose of the program. Why does the 504 exist, and what are some of the basic eligibility criteria to qualify for a 504? So a 504 program is typically known for job creation. In order to qualify, most people think of the program that you need to create a certain number of jobs to be eligible for the 504. And that is the primary goal of the program. So when you look at a project, specifically let's talk about the cities of Bismarck, Fargo, and Grand Forks, where your population is over 50,000, that is a lot of times going to be the eligibility criteria for the program. So when we look at it, as far as figuring out the number of jobs that need to be created to qualify, you would take the 504 portion of the project, the $504, divided by 65,000, and that would give you the number of jobs that would need to be created to qualify for the program. Manufacturing is a little bit less because we're dividing by a bigger number, so you would take the 504 portion divided by $100,000 to find the number of jobs to be created or retained. But once you get outside of those cities, the city limits of those cities, where we're into rural areas, rural development can be the primary eligibility criteria to qualify for the program. So if you're in Mandan, if you're in West Fargo, if you're in Minot, Williston, any small town, instead of using a job creation eligibility, we can use rural development as the primary eligibility factor. Other things when we look in the cities, Fargo, Bismarck, Grand Forks, instead of job creation, or if job creation isn't a major consideration of the small business, it can be a minority-owned business, a veteran-owned business, or a woman-owned business. And as long as it is 51% or more of any of those categories, that could be your primary eligibility factor as well. There are some lesser-known and lesser-used eligibility criteria, including community development, business district revitalization, economic competition enhancement, or expansion of exports. So if you don't believe that the project qualifies under the main reasons, give us a call, talk to us, and we'll see if we can figure out a way that it would work. Another purpose of the program is to support small businesses. So the SBA defines a small business according to the following size standards. The small business would need to have a tangible net worth of less than $15 million and an average net income for the last 2 years of less than $5 million. Now, where it can get a little bit complicated is in affiliates or affiliation. So what the SBA does is they look at not only the small business, but any businesses that may be owners of the small business, or the owners of the small business may have ownership in other entities. So sometimes we need to look at those entities and sometimes we don't. And that's, like I said, that's where it gets a little bit complex. And we would just need to take their net worth and their average net income into consideration for the size standards as well. So don't try to guess on this one, because there's a lot of unusual situations that we can get creative with. So give us a call, and again, we can help figure that one out as well. So what can the funds be used for in the 504? As I mentioned earlier, typical or the most common known uses are for the purchase, construction, or remodel of owner-occupied real estate. Now, if it's existing property that's being purchased, it has to be occupied at least 51% by the owner. And if it's new build, it has to be at least 60%, with plans to get up to 80% over a period of time. Another use that isn't as commonly known is for leasehold improvements. We can finance leasehold improvements under the 504. It typically would fall under the 10-year term instead of the 20-year term that you would get for real estate. But it is an eligible use of funds under the 504. The 504 can also be used to purchase or install new or used equipment. So any equipment that's long-term equipment that has a life of at least 10 years can qualify under the 504 program as well. We can also roll in other eligible costs associated with the project, such as engineering and architectural costs, appraisals, environmental reports, utility hookups, title insurance and recording fees, permits. We can include interest and fees on the interim or construction loan. We can also build in a construction contingency of up to 10%, because as we all know, construction never comes in exactly as planned according to the proposals. Debt can be refinanced under the 504, and we'll talk about that separately here in just a bit. So as you're working on a project, if there's things that you're not sure if they can be included or not, here again, just give us a call, ask, and we'd be happy to help figure that out. So some less commonly thought of uses for the program. While a straight out real estate purchase is frequently thought of as a use of the program, when that happens in conjunction with a business acquisition or a partner buyout, we can also parcel out that portion to finance under a 504 program. Now, the 504 program cannot finance inventory or working capital or blue sky in a business acquisition or partner buyout, but we can proportion out the costs that are eligible and finance them under the 504, and then the other costs can be financed separately. So while it's not commonly thought of, those are reasons that you could use the 504 as well. Specifically on the debt refinance, if somebody is doing a project that includes the items that we talked about above, the real estate purchase, construction, remodel, purchase of equipment, and they also have existing debt for any of that type of eligible use, if the existing debt is no more than 50% of the new project, we can include debt refi in the 504 as well. So why would you consider a 504? Let's start with looking at it from the perspective of the borrower. As I mentioned at the very beginning, a lower down payment is a significant benefit to the borrower. Conventional financing, we see anywhere from 25 to 40% down payment required from the borrower to finance a project. With the 504, they can get in as low as 10%, allowing them to preserve working capital for business operations. Now, when I say as low as 10%, here's a chart that shows how the basic structures of the various projects could look. If we start with the standard structure, The primary lender would take 50% of the project, the 504 would take 40%, and the borrower would have a 10% cash or equity contribution. Now, if the business is less than 2 years old, or if it's special purpose property, which I have listed at the bottom of the slide, then the SBA 504 portion reduces to 35% of the project, and the borrower contribution increases to 15%. In the case where it's both a new business and special purpose property, the SBA 504 portion reduces to 30%, and the borrower contribution increases to 20%. There can be other structure considerations as well. If the appraisal doesn't come in at least 90% of the total project, then the borrower will be required to contribute more. There may be instances where the primary lender wants to do less and have the borrower contribute more, which can be done in some circumstances. But one of the key things to note is that the primary lender portion must always be greater than or equal to the 504. It can never be less. So the next benefit to the borrower is a below-market fixed interest rate, which mitigates interest rate risk. With conventional financing, typically the rate is reset every 5 to 7 years. And with the 504, it is a fixed rate for the entire term of the loan. So on a 10-year debenture, this chart on the screen shows the historical rates for both the 10 and 20-year debentures. You can see on the 10-year debentures, it's been hovering at about 4.5, 4.6% for quite some time. And under the 20-year debenture, we've been hovering right at about 5 to just a little bit below 5% for several months as well. So those rates have been holding steady, and that is a fixed rate for the entire 10 or 20-year term. Some additional benefits to the borrower. With the fixed rate and lower down payment also comes a lower monthly payment because it's amortized over a longer term, either 10 or 20 years. And all of these three things add up into an improved cash flow coverage situation for the borrower. Another benefit is that most of the fees and closing costs of the 504 can be financed in with the 504. The only exception is the third-party lender fee, which is 0.5% of the third-party lender portion of the 504 that's actually due at closing. The rest of the fees are rolled into the project, and since the interest rate for a 504 is below market, typically we see it about 1% less than the primary lender rate, the fees are usually covered with the interest savings within a period of a couple years. And also another benefit, a lot of times the borrowers and the lenders will look at the 504 versus the 7A. And one of the things that we wanted to cover in a little bit more detail, and I'm going to turn the presentation over to Steve for this next comparison, is looking at the 7A fees versus a 504 fees for a comparable project. So Steve?
Okay, thanks, Roxy. A lot of times, as Roxy mentioned, there's two main programs that SBA has for small businesses. One is the 504 that Dakota CDC delivers and lenders cannot. And then one is the 7A loan program where Dakota CDC can deliver in certain circumstances, but most of the time this is delivered by lenders and or credit unions. So we often get asked about a comparison between the benefits and the value of both and what makes the most sense. The easiest way to describe it is on a 504, they end up with a third-party loan from one of the lenders and a loan from Dakota Certified Development Corporation, where the 7A comes entirely by the lender. So we tried to detail out as best we could with some variables that we see, and again, you can move the rates or the terms or the fees around and get a comparison. But if you look at the three columns to the left, they're the ones that have the heading of project percentage, and then there's not a heading. Those are the three related to the 504. So we used a standard project of $1.5 million, and you can see there, starting from the left, the lender would do 50% or $750,000, and we used a rate around 6.25 at 20 years with a small amount of bank fees. And then the debenture or the 504 loan is the 40% or $600,000, and we used the rate of the last bond sale in New York, which was 4.91. Then if you follow it down a little further, you can see the standard 504 fees. There are fees set by SBA. The CDC processing fee is where Dakota CDC makes their money and his ability to operate and deliver the program. There's a closing fee that covers a number of things from environmental to filing fees to opinions, those kind of things, and that's an estimate. Then SBA has a guarantee fee, and then the next two fees go to the underwriter and the bond sale. So you can see on a 504 at $600,000, there's $18.4 thousand of fees associated with that, and if you walk down to the bottom, you can see what the monthly payment is: $5,509 for the lender and $4,054 for the 504. To the right of that then is the total payment and the total fee amount associated with that. Now, if you look at the very far right column on a 7A loan, and as Roxy mentioned, it is unlikely that a conventional or 7A loan are going to only have a 10% down payment, but we use that to keep it consistent as well as for analysis purpose here. So assume the business puts down 10%, then they're going to borrow $1.3 million, $1.35 million from the lender. And there's an interest rate, we use the 7.25 because there are some ongoing fees that the lenders must pay to SBA for that guarantee. And those are usually calculated into the interest rate. And they can be generally around 3/4 of a point. We use a 10-year term with a 20-year amortization and a small amount of bank fees. So you can see the guarantee, the upfront guarantee fee that the borrower must pay to SBA is $35,469. With the 1.5% of the bank fee, you can then see the difference of the total fees: $55,000 for the 7A and $22,000 for the 504. So that's about a $33,000 difference in fees. And then you can see the total payment is around $11,100. So over the course of 20 years, again, making the assumption that they pay the payment of both the bank and the 504 on the first of the month, every month for the full 20 years, and they do the same with the 7A, it's over $300,000 of savings for the life of the loan. So you have the upfront fees associated with the loan, and you have the ongoing payment, and that's generally the comparison between the two. Roxy?
All right, thanks, Steve. And just another side note, we do have a 504 calculator available on our website, dakotacdc.com. But if you ever do want to see a comparison on a project of a 504 versus a 7A, get a hold of us. We do have a calculator within our internal system where we can run a comparison like this, and we would be happy to do so for you. So the last benefit that we wanted to mention on the borrower side for this morning is that collateral is typically limited to the project assets. Unless we're looking at leasehold improvements, which could put us in a position to look at additional collateral, typically the equipment and the building are sufficient collateral for the project. So then let's look at it from the perspective of the primary lender. Why would you consider a 504 as a primary lender? It's an additional option to meet your borrower's needs. It gives them some significant benefits on the financing on their side as far as, the interest rate and the down payment. The loan-to-value ratio for the primary lender is going to sit at 50% because we're sharing in the risk of the loan. It is a subordinate lien position, meaning that the primary lender has the primary lien and the 504 portion is subordinate to the primary lender's portion. It can help address legal lending limits, so you would be able to finance larger projects and multiple projects to one borrower. The third-party lender maintains customer relationship and deposits. We don't get into any of that stuff. We simply do the 504 loan for the customer. One of the things that's also not very widely known is that the appraisal can be as low as 90% of the total project cost. So as long as the appraisal comes in at 90% or higher, we're good to go. If it comes in at less than 90%, then the additional borrower equity or contribution would be required. The application for the 504 processing can be outsourced to Dakota CDC. You don't have to know the paperwork. You don't have to go through the process. We'd be happy to do that for you. And we have involvement from little involvement on the lender side to taking care of the whole process depending on the lender. And typically when we get involved from the beginning and we're able to meet with the third-party lender and the borrower, things go really well and we're able to help pull the paperwork together, get it processed accurately, and move through the process quicker. Another benefit to the primary lender is credit for the Community Reinvestment Act. So some successful lender strategies, from what we've seen when primary lenders employ these different strategies, the program is successful for them. Use the 504 to help your best customers, not just your marginal deals. Help them get the best deal, the best financing terms for their project and their business. Offer the 504 as a structuring advantage before your competition does. Now that's something that we're seeing more and more, is that people are shopping and looking for better rates and better terms between the financing institutions. It helps build loyalty with your borrowers because you're offering the better terms up front. If you develop a relationship with the CDC officer for your area, we'd be happy to accompany you at customer meetings, answer all the technical questions, and walk through the process with them. One of the things that we can do is share information between the lender and Dakota CDC to expedite processing. Therefore, the borrower doesn't have to submit duplicate information. If they submit it to us, we can share it with you. If they submit it to you, you can share it with us and save time on the borrower side. If we agree on the financing structure before the credit approvals are completed, that always helps the project go quicker as well. And where there is a need, we can work in conjunction with other financing programs as well to complete the deal. There are frequently multiple components to a 504 project that may include other CDC financing programs. It may include a local economic development program. The bank may use the Bank of North Dakota on the backside for different pieces. We're used to working with a lot of different entities to pull the project together. So what it all boils down to is a lower down payment starting at 10% plus below market fixed interest rates equal better terms for the borrower and better risk positioning for the lender. So when we put it all together, the borrowers have the ideas. They're the small business that's growing, starting, doing something new. There are tons of financing tools in the toolbox. So the lender that's visiting with the borrower pulls it all together, and it ends up, this is why we do what we do every day. This is why you guys do what you do every day, is to see small businesses succeed, get off the ground, grow, do new and interesting things. So just a little bit about Dakota C and why you would choose to work with us. We exist to provide opportunities for entrepreneurs and small business owners to achieve their dreams through unique and creative financing packages. We've been doing this since 1983 and have delivered over $450 million in small business loans with a total financing impact, total project financing impact of over $1 billion in the state of North Dakota and in western Minnesota. So to do that, we've had to work with lenders, borrowers, economic development professionals, and other partners throughout the state. And we have staff in Fargo, Bismarck, and Minot to easily cover the entire state and be available to meet with people whenever needed. We do have a 9-member board of directors that's strategically represented from across the state. It represents lenders, small business, economic development, and government representatives. We are the only CDC in North Dakota with accredited lender status and ASM processing, which allows us to make servicing decisions on loans that are funded. We are able to submit reduced application to the SBA, which results in an expedited and quicker SBA turnaround. Typically, once we get a loan off to the SBA, we are seeing approvals as low as 4 days. So that's a significant number, whereas some of the competition, the numbers are well over 30 days. And as a private not-for-profit company, we invest tens of thousands of dollars annually in various statewide economic development efforts. Historically, that has included the SBDCs. We invest in the Women's Business Summit through the Center for Technology and Business, We are a founding partner of the Impact Foundation Fund and a number of various other economic development efforts statewide. Excuse me. So that being said, we will move to questions. And right now I see that I have one question so far, Steve, so let me shoot that out. And if anybody else has any questions, please type them into your control panel. All right. Oh, Steve, the question is, we're recording the call, but there's a question if we can provide a copy of the presentation that they can print out.
Yeah, I don't think that would be a problem. We can do that to anybody who's on the call, sure.
Okay. So yes, we will be able to.
If they want to just drop you an email, Roxy, you'd be happy to get it out to them.
Okay. So the next question, what is the max limit on the CDC portion?
The max limit is $5 million, so that would be the 40%. That means you can do a project, a total project, a little over $12 million.
All right, any other questions? I'll watch my control panel as we hit the next slide here. But after the fact, if you have any questions, feel free to give us a call as well. So the next webinar that we plan to do, join us in October. We are going to do a follow-up to this webinar on how to make the 504 easy or easier, might be a better way to say it. We will go through the application process, tips to keep the process on track, and some of the common gotchas that come into the loan application process. So I see that the next question that came in is email address. You can see it here on the screen. My email address is Roxy, R-O-X-I, @dakotacdc.com if you would like a copy of the presentation. And again, I cover the southwest corner of the state. Christy Williams is our contact for the northwest corner, and Steve Dushik covers the eastern half of the state. You can see our contact information there as well as our website. You can follow us on LinkedIn, Google+, Facebook. Steve, one more question. What are the client credit score requirements?
Great question. I would say that it's not simply just about the credit score. So there's not a minimum or not a low score. And I guess I'll use a couple of recent examples that Dakota CDC did to explain that. You know, we had an individual borrower of ours that had some challenges with a family member and some personal issues that they were helping them with when they were in high school, and their credit scores were in the low 600s, maybe even the high 500s. And it was all explainable due to the situation, and the situation isn't that important, but the point is that the borrower was able to clearly explain to us and to the third-party lender, as well as SBA, why the circumstance or why the situation existed, and that project was approved. So, you know, there can be challenges with credit, there can be bankruptcies, there can be, you know, situations like that arise. We need to clearly explain them. It does, you do look at the overall project and the overall credit, and so there are times where you're honing in on that. You may need more detailed information. You may need full court report if it's a bankruptcy. Those kind of things that, as long as they're explainable, it is eligible and it is something to consider. It just goes back to the overall credit. Now, if there are tax liens, federal tax liens, or past debt that has been forgiven by SBA or any government entity for that matter, maybe a home loan through rural development or maybe a student loan through the Bank of North Dakota, if there's any government debt that's been forgiven or written off, then that all has to be cleared up before it's eligible. But in relation to just the credit score, there's no bottom that disqualifies them.
All right, thanks, Steve. And it looks like that is the end of the questions, and that is the end of our information for today. So on behalf of all of us at Dakota CDC, I would like to thank you for joining us. And again, watch for information to follow for the next webinar in October. If you did not directly receive the invitation to join this webinar and would like to be on our list, shoot me an email as well, and we'd be happy to add you to our mailing list so that you do get all of our communication going forward. So thank you and have a great day.